Welcome to The Explainer. Today, we are pulling back the curtain on a trading philosophy that's got everyone talking, smart money concepts. We're going to dig into what it is, why it's so divisive, and, what it might just teach us about how the market actually works.
All right, let's kick this off with a feeling that I'm guessing is painfully familiar. You do all your homework, you find the perfect entry, you place your trade, you even set a super smart stop loss. And then what happens? Price comes down just nicks you out by a single tick, and then boom, it rockets in the exact direction you knew it would go. It feels like the market's got it out for you, right?
So that whole experience, it leads us to this really big question that's at the core of smart money concepts. Is the market just random chaos? Or is it something else? Is it a game with rules, a field that's been, engineered by the biggest players?
Well, to even start answering that, we have to get our heads around the main idea of smart money concepts. It basically frames the market as a tale of two traders, a constant battle between two totally different groups.
So on one side, you've got what they call smart money. And look, this isn't some shady guy in a basement. We're talking about the big institutions, the hedge funds, the banks. Their orders are so huge, they literally can't just press buy like we do. It would completely wreck their own entry price. They have to be sneaky. And then on the other side, there's us, the retail traders. We're the ones who are, for the most part, just reacting to the waves that they create.
So what's the big goal for smart money then? It's one word: liquidity. It's just a fancy term for a big pile of orders. See, to get their massive positions filled, they need tons of people to sell when they want to buy, and buy when they want to sell. And where can they find a predictable pool of orders? Well, think about it. Right above those clean highs and right below those clean lows. Exactly where we're all told to put our stop-loss orders.
Now, the central belief of SMC is that these big institutions, they can't hide their moves completely. They leave clues, footprints, if you will, all over the chart. So let's try and decode their language, see if we can follow the tracks of these giants. First concept we got to know is called inducement, and really just think of it as a trap. It's a move that's designed to look super obvious, right? It makes a certain level look like a great place to buy or sell, luring traders in. This induces them to put their stop losses right where that big pile of liquidity, that trap, is being set.
Okay, next up we've got order blocks. Now, a lot of people in the SMC world see these as the clearest footprint you can possibly find. It's supposed to be the specific candle, the point of origin, where a massive institutional position was kicked off just before the price went absolutely vertical.
So, this is what they look like. A bullish order block? That's the last little down candle right before a huge push-up. A bearish one? The last up candle before a big drop. The whole idea is that price often comes back to these spots. Why? The theory is that the institutions need to come back to that price to fill the rest of their huge orders. And then there's something called a fair value gap, or FVG for short. I want you to think of this as a sign of pure speed and power. It's what happens when price just explodes in one direction so fast that it leaves behind a little pocket of air, an imbalance in the market.
You can spot it pretty easily. You'll look at 3 candles in a row, and if there's a gap between the top of the first one and the bottom of the third one, that's your FVG. And these gaps, they often act like a magnet. Price has this tendency to get pulled back into that zone to fill the gap and sort of, rebalance things before it decides where to go next.
Okay, so all of this sounds pretty cool, right? Like we've just been handed the secret decoder ring for the markets. But here's where it gets interesting. There's a very strong argument that none of this is new at all.
Yeah, a lot of old school traders, the critics, they'll tell you that smart money concepts is just classic price action with a fancy new name, that it's the same stuff traders have been looking at for decades, just rebranded with really complicated, maybe even overcomplicated jargon.
And honestly, when you put the terms next to each other, it's kind of hard to ignore. What SMC calls a breaker block, well, that's just support turning into resistance. Institutional order flow looks a heck of a lot like just trading with the trend. The underlying ideas are often exactly the same, it's just the labels that are different.
And history kind of backs this up, The core concepts of analyzing price action have been written about since the 1930s in books by guys like Richard Schabacker. But the term smart money concepts, that didn't really show up until around 2010 on some trading forums. So yeah, the ideas themselves, they've been around for a long, long time.
So if the concepts aren't new, what's the point of this whole debate? Where's the real edge? Well, maybe the takeaway is that we're focusing on the wrong thing.
It shifts the conversation away from the magic strategy and puts it right back on the trader.
So, if it's not the entry technique, then what is it? What really separates the winners from the losers? Well, if you ask any veteran trader, they'll tell you that the huge majority of your success, it doesn't come from your charts at all.
That's it. More than 60% of your success in this game is all about your psychology and your risk management. That's the one universal truth. I don't care if you're trading SMC, support and resistance, or anything else. The real edge isn't finding the perfect pattern. It's mastering your own mind when your money is at risk.
But hold on, that doesn't mean these ideas are useless. Not at all. The real power of a system like SMC, or any good system for that matter, is that it gives you a framework. It gives you a logical, step-by-step way to look at the market. Step 1, you see a liquidity sweep. Step 2, you find a nearby order block, or FVG. Step 3, you wait and watch for price to confirm your idea. See? It helps you build a story for why you're taking a trade instead of just gambling.
And that kind of leaves us with one final question, doesn't it? Whether you call it an inducement or a stop run, a fair value gap or an imbalance, does the name really matter? The market is going to do what it's going to do. The only thing that truly matters is, can you see what's happening, and more importantly, do you have the discipline to act on it correctly?